Hello, and welcome to the East Africa Business Podcast. I'm Sam Floy, and I'm here on the continent to learn about the emerging business scene. I'll be interviewing startups, investors, and organisations who are all playing their part in helping the region develop and grow. And in doing this podcast, I'll be sharing with you the things that I learn along the way. Working capital in East Africa is tough to get your hands on. Umati Capital are looking to help, using technology to give credit where banks won't, typically through giving food producers in advance when a big order comes in. Ivan and I talk about how the legal environment means issuing credit is tough, how they evaluate their clients, and their vision to professionalise the supply chain across the continent. It's similar to the SME financing episode with Baka from Patasense, so give that a listen to if you find this interesting. I should also note that the only room available in their co-working space was quite echoey, and so the audio quality for this interview isn't great. A couple of answers get lost, and so I'm sorry about that. Nevertheless, I hope this doesn't detract from what is a very interesting interview. So I'm here with Ivan from Umati Capital. Ivan, welcome to the show.
Thank you very much.
Cool. So just to get us started, could you tell us a bit about Umati Capital and a bit about yourself?
Sure. So my name is Ivan Mbowa. I'm one of the co-founders behind Umati Capital. I started Umati Capital with my colleague Munichu Waigi after spending 8 years in banking with Citibank. I worked with them in Uganda, in Kenya, in South Africa, in Ghana, Nigeria. And Munichu's background is in management consulting and technology. And when we met to start Umati Capital, it was really to address a gap that we saw in the market around how small businesses were struggling to access capital from banks. And largely because banks were required them to place collateral to access financing, they would take a very long time between receiving the applications and making a decision about credit. And we thought that we could use technology and structured finance to make it a lot more efficient and faster for small business to access capital. So in a nutshell, that is really the story behind how Umati Capital got started.
So just so I've got this right, you provide financing for small businesses where banks don't.
That's correct. So we are, the technical term would be working capital providers. The simple term is to say, we provide bridge financing. A typical client is a manufacturer of a food product who buys those raw ingredients from farmers and cooperatives and needs to pay them as soon as possible when he collects the goods and sells them to supermarkets. And supermarkets will take up to 3 months, 4 months to pay. And the farmers cannot wait 3 to 4 months. So what we do is provide different products that allow us to bridge this gap between money that must go out and money that's expected to come in, so the business continue to grow and function.
So in the 3 months, so just so I got this right, let's say you've got a contract, you need to pay your farmers, but you're not actually going to receive the money. It's not like you go into a shop and you pay for something immediately and you get given it. There's this time period.
Absolutely. So you bought milk from your farmers. You processed the milk into cheese and yogurt, you sold it to a supermarket, they've accepted it, but they haven't paid you. They're going to pay you in 3 months' time.
Why don't they pay you immediately?
Well, 2 reasons. Officially, they'll say that contractually they need time to be able to recover cash from your sales. But in reality, it's just because they can afford to actually make small businesses wait. It's a global phenomenon, so I just can't. You look at the Tesco's, you look at the Walmarts, they all make the suppliers wait. And they squeeze them on pricing. So what you'll find is that as a manufacturer, you're torn between, should I distribute my product myself and get cash every day, or should I work with large supermarkets and to maybe 10x, 20x my sales, but have to wait 90 days.
And then what are the other than having to pay the farmers? I mean, what are the problems with waiting 90 days?
So many. Essentially, you've got to think about, as a small business, what are the various reasons I need cash? So one is paying suppliers, paying staff, typical. But the next one really is that there's an opportunity cost to not receiving your money sooner, especially if you're in a business that has a great degree of demand for its products, and you have limited capital with which to actually go ahead and produce these products. So the faster you can be paid, the more products you can produce and sell. And so in actuality, you almost find that getting an advance on what is owed to you from your clients has a multiplier effect on your business. One simple example I like to give is if you've sold 100 units of a good and you have to wait 30 days, you'll only ever make 100 units worth of goods. But if you sell 100 units worth of goods and in the first week I give you back 80 as an advance, and you go ahead and supply 80, you've done 180 in sales. And if you do that over and over, say in the third week, you discount the 80 and get 64. Now it continues, 224 compared to the 100, and so on and so forth. So this is the multiplier effect. I hope without getting too technical, that is, why would someone want to get an advance? What is the cost to not getting paid early? In simple terms, it's, potentially you risk losing your suppliers and your staff, and you risk losing, not doing more business.
And so what were the options for these suppliers before Umati Capital came?
For many of our clients, they'll be the first time that they're accessing formal credit. They could not access from a bank because they did not have collateral pledged to a bank. So what typically happens is that they'd have to wait 90 days. They'd have to use out the 90 days of business not done. They'd have to potentially lose risk in suppliers. If you're lucky enough and you have access to capital from other businesses, you end up using, cash from other businesses to essentially plug the gap in this business.
So why do banks ask for collateral before giving money?
Good question. So the banks do have a reason. Typically, you found that in most normal markets, so let's say markets outside of Africa, you'd have this concept called cash flow based lending, which is your business, you have expected future cash flow. I can lend you and you'll repay it in that manner. That works all well and good until something doesn't, i.e., let's say the borrower defaults, decides not to pay or cannot pay. You'd hope to go to a court and be able to recover your funds. But you'll many times find that the commercial courts in markets like Kenya don't function well, right? And so it's a lot easier for a lender to say, well, this client has pledged this collateral to me as security for this loan. And if something goes wrong, it's very easy for me to go in and reach to liquidate this collateral and get my money back. So it was really, I think it was a function of, courts, commercial courts that do not work efficiently and quickly.
So based on the sort of the risky legal environments, the banks say we only want to take on collateralized loans. Am I right that you take non-collateralized loans?
That is correct, more or less. We have certain tiers of credit that we make available to clients, but the reason we're able to actually go ahead and provide non-collateralized loans is that we've thought of different ways of protecting ourselves. So we thought, for example, if I go ahead and give you an advance against sales you've made to the supermarket, my risk really lies on the supermarket, but the supermarket's on my client, right? So what I need to ensure are several things. One, that when the supermarket is repaying, they're going to repay to an account that I control, right? So I need to have what we like to call in lending cash dominion, control of the cash flow. Second, I need to protect myself from the risk that this supermarket doesn't pay. So how I do that is I work with credit risk insurance providers. So I take an insurance contract out on the risk that if supermarket A should default or go bankrupt before I'm due to get paid for the invoices I've discounted, will you, the insurer, pay me? And in exchange for that policy, I pay a premium, just like car insurance. The risk that this car may get into an accident and I may need to pay. Likewise, I go to credit risk insurers here in the market and say, I'm financing these invoices that are about to be paid by these clients. What if these clients go bankrupt? What if these clients default? Can you protect me against the risk? But they say yes, if you're going to pay this premium. And so that's how we function.
Why haven't banks done that?
Well, in simple terms, I'd say that there's much lower hanging fruit. You can only use the structure I'm talking about in specific lending products. But for the majority of other products, you really do need to have some form of collateral, and many borrowers are just willing to give collateral. So the question would be, why sort of go into complications of arranging credit insurance and exposing yourself to slightly more risk when there are 10 other borrowers willing to give you what you want, right? So I'd say it's very much, it's a bank's market, right? They write the rules, they control the rules. People adhere to them. So it's only new entrants like ourselves who have to make ourselves relevant and have to go the extra mile to actually ensure that clients will say, okay, let me give you a chance.
And how do you make money?
Well, now that I've criticized the banks, I'm going to tell you how I work exactly like a bank. So how we make money is we earn interest for the period in which we give you funds until you repay us, or rather until your buyer or your supermarket repays you. So, for example, you could come to me and say, I need to get an advance of 100,000, and I will say, when are you expecting the 100,000 to be paid? And you'll say 30 days time. And I might say to you, okay, well, in that case, I will charge you 2% on this 100,000, right? And then you'll give me then 2,000 shillings once the invoice is paid, plus the 100,000 I gave you. So we make money essentially by charging interest to our clients for the period of time in which they have our funds until those funds are repaid.
And is it typically 2%? What's the rough percentage?
It will range because, and I'll tell you what, our advances are paid within 56 days. So most of our clients will only have money for less than 2 months. So the charge that they'll pay for will be, in those 2 months, a minimum of 4% and a maximum of 8%. So if you, again, using a 100,000 shilling example, I advance 100,000 to you, at worst you'll pay, at best you'll pay 2,000. So 2,000 per month or 4,000 for those total 60 days, and at worst you'll pay 8,000.
And are most customers happy to do that?
Oh, yes, they are. I mean, if you look at the interest rate from a normal perspective, it does look high, right? 2% for 30 days looks like 24%. And then if you look at banks now are forced to lend to clients at 14%. But the devil's always in the details. So we tell our clients, well, what is the cost to you of not getting this money early and not doing business? Or rather, are you able to make more money than what I'm charging you? So if I charge you 2% for 30 days and I give you back 100,000 shillings of your own money, can you go out there in the market and make more than 2%? If you cannot, don't take my money. If you can, then it makes sense, right? And for most of our clients, we've been able to help them grow their sales, I'd say 40% and more. Where clients have grown astronomically just by that multiplier effect. Because it really is as if they went from selling to a customer that paid them every 3 months to selling to a customer that pays them every 2 weeks. When the cash comes in, well, they can do more sales. They can produce more, sell more, and on it goes.
So how many clients do you have?
Well, I'm not limited to disclose that. We keep our book very private, but what I can say is this year alone, we have discounted well over 1,000 invoices for our clients. And so we continue to do quite a lot of business.
And you mentioned that sort of the problems start occurring if the buyer doesn't pay. How do you evaluate whether a buyer is going to pay or not?
All right, great question. So for us, we look at the invoice really as our true security. So we analyze this invoice and invoice history very well. So if you come to me as a new client and say, well, I want you to help discount my invoices to the supermarket, I will look at, in the past, when you invoice X, how many times are you actually paid X? How many times are you paid less than X because of quality issues with your goods? How many times does how late does your buyer pay you against the stated contractual terms? The buyer is supposed to pay 60 days, pays an average 150 days. Tells me a lot about the quality of risk I'm taking. I will look at your stats against the average that we have from other clients that we deal with. And ultimately, we call it the health of the receivable. So we really look and say, how healthy are your receivables as a business? And then we'll sometimes determine, well, this is risk that we can't take on. If we are on average at 56 days, do I want to take on clients that are going to drag me to 100 days? Probably not. Yeah.
So you're doing your checks on the buyer from the client's past activity.
Exactly.
Do you mean in the example of the supermarket? Do you ever go into the supermarket office and try and see what's going on?
Impossible. I'll tell you what, for supermarkets and the buyers of our clients, we are sometimes a pesky third party as far as I'm concerned. We're the ones that start following up with payments. We want to make sure the payments are coming direct to us and present a whole variety of new challenges. These challenges are good. In fact, in many ways, we've actually helped professionalize a lot of our clients. So this has been a key part of how we're able to do this business well.
So in general, it sounds like you're kind of making the buyers sort of holding them to account.
Okay.
So are they sort of, what's their reaction to you?
It ranges. Ultimately, I think to buyers, we say to them, if you can get your suppliers onto this, I can assure you of a more stable supply chain. Because eventually, at some point in time, if you keep on holding payments to your suppliers, they'll come and bite you. There'll come a time when you need your supplier to deliver X amount of goods, and they'll say, well, because you haven't paid me for the past 3 months, I'm out of capital. And unless you have a multiplicity of different suppliers, it's going to actually go ahead and ruin your business. Although some other buyers say it differently. Some other buyers say, well, I was used to paying these guys 90 to 120 days whenever I wanted. And now you want me to formalize this? I don't want to sign on anything with you. And if that's the case, then we cannot do business. We will not do business with a client whose buyers are not comfortable with us.
Okay, let's take the buyer side for a bit. What is a legitimate reason why a buyer wouldn't pay a supplier?
Sometimes actually you'll find that buyers are middlemen. They're buying from a supplier, selling to someone else. And sometimes that person hasn't paid them. So they're saying, you want me to pay you in time, but I don't have the cash flow. That's legitimate to me. The illegitimate reasons are, well, you want me to pay you in time, but I actually have this construction project and it needs quite a bit of cash. So I need to pay my contractors first. So I'm going to use your cash to complete my project, which is a very common case. Ultimately, it really ranges from, the third one would just be, we're disorganized. In fact, that happens a lot. You're one of thousands of suppliers, and you give me 10 invoices per month. I have 10,000 invoices to go through and sort. I just don't have the time to go ahead and process and pay your time.
Is there ever a time when the supplier might give the produce, but I think you mentioned that maybe the quality is not good? Yeah, what happens in those scenarios?
Yeah, that's a difficult one. It happens, especially with we're in the agriculture sector. It happens quite a bit. In such a scenario, we basically say that our financing has recourse back to our client. Meaning, if I discount your invoice and it's not paid due to reasons related to the quality of supply, you owe the money. Yes, you're the client. It changes from you, your buyer, to you. And we'll then ensure that our clients have given us personal guarantees and other forms of security to protect ourselves.
Okay, so whilst you're taking an uncollateralized financing, you do actually have something.
Yeah, in terms of, it won't be physical collateral, but we have ways of ensuring that we can go back and recover our funds if necessary. Right? We can tie our clients to this issue.
What are you most excited about doing in the next 6 months?
I think in the next 6 months, we are looking at launching a new product we call supply chain finance. And that's really working with our existing clients and going ahead now and provide their suppliers with this similar financing. So we're going to make our supply clients buyers, right? So ultimately, it's really deepening, how our product goes downstream, and strengthening also our hold on our clients and making sure that we are embedded. They see us as true partners. We're not just advancing funds every now and then. We're ensuring the entire value chain works.
Just so I've got this right, at the moment your client is, let's say, a tin tomato company, and they've got a contract with a big supermarket. You're now, and at the moment that's you. So you're currently bridging between the supermarket and tin tomatoes. You're now saying where this tin tomato guy gets his tomatoes, you're then going to finance that as well. Is there similar demand for those products?
Absolutely. No one is selling it. Over here, if you think about the tin tomato in the supermarket, banks are willing to do it if you want to give collateral. But if you're the tin tomato farmer, there's no one who's going to give you unsecured, uncollateralized working capital against your sales to this tin tomato manufacturer. So we're diving down deep into not the unknown, but rather the true underserved.
Okay.
Yeah.
Why?
Why are we doing it?
Yeah.
It's a much bigger problem to solve, and I think we're on that. Right? And ultimately, we face a lot of pressures and competitive pressures up here. The further down we go, essentially not only are we doing good, but we're also going in as first mover advantage. There's no one else up there. There's tremendous need for it. Why not go there?
Why? It sounds quite risky. That's the why not.
So, that is true. But no risk, no reward. Every business has a risk. But there are ways in which we can structure it to make it less risky. So I'm very excited about that personally. It's the one I think it'll fundamentally move our client numbers, our volumes, introduce us to new complexities, without a doubt. But it's uncharted territory.
Will your team be able to cope? I mean, what size are you currently at?
So we have a team size of 12, and so for us to do the supply chain finance, we're going to use a lot of technology. We already use some technology with our clients, but now everything from how we acquire the farmers to how they ask us for funds, how we give statements, all of it will be automated on mobile, through USSD YouTube applications, because that's when we can service that. We're talking about at least next year, we're talking about going to about 15,000 clients in that section. And it'll probably still be a team of less than 20 people, right? So you truly need technology to actually serve such a mass.
How are you going to go about sort of developing that product?
Oh, we've actually already developed it. I don't give trade secrets away, but what I will say is that it's very much I'll say it's very much a slight twist on our current product. Right? We have the technology resources in-house. We have the risk management controls in-house. And so we've spent actually quite a bit of time. We've been working on this since July. And we're looking to launch and get some of the first supply chain finance products out before the end of October. And really know that as we go into January and March, we're really on full blast.
Do you need to consider anything about sort of seasonality if you're working in the agriculture sector?
Yes, seasonality doesn't give us risk in lending, but rather commercial risk. And commercial risk in terms of demand for our product, right? If I have tremendous exposure in grains only harvested twice a year in Kenya, I'll have, about, let's say, 4 to 5 months where there'll be some great demand and then nothing. So we like to get a blend of different clients. You'd find that the manufacturers in those sorts of markets will sell year round. The moment you start going into supply chain finance, there's definitely a lot of seasonality. Now, talking about clients who will say, supply the raw inputs to the manufacturer maybe 3 times a year. If it's milk, it's every day. There's a lot of variance. So seasonality, I'd say, is there for sure because we're focused on agriculture and agribusiness, but it's not a risk. The banks have historically said we're not going to put money in agriculture because it's risky. If the sun doesn't shine, if it rains too much, or so on and so forth, we'll lose money. We won't lose money, but rather we will lose demand for our product. So more of a commercial risk.
It seems that if you're going to be financing people, you must need quite a lot of capital yourself. Where does that capital come from?
Good question. Where does that capital come from? It comes from a variety of sources. We work with institutional funders. So these tonight would be specialist trade finance funds who understand the nature of what we're doing. We work with a few high net worth individuals who have the sophistication and the understanding of complexity to go ahead and invest. We work even with the crowdfunding side. So we essentially have a hodgepodge of different funders that actually give us the capital to on lend.
So with these people, are they expecting a return? When are they expecting to be paid back? Is it that they're investing in Umati Capital, or is it that they get the money back?
So we get the money back. So, and I have to be very careful here because we're not a bank. So I need to be very, very distinct. We work with investors who are looking for short-term returns. So they'll say, I'm going to invest funds with you for 6 months, for 12 months. And at the end of these 6 to 12 months, this is the return that we'll agree that you'll pay me. And that return it's almost similar to a depositor in the bank, although it's not a deposit. Just to be clear, and no one get in trouble with the lawyers and the central bank. It is a bilateral investment between 2 parties. And they'll say, hypothetically, I'll give you money at 1% for 30 days, and then we will go ahead and lend that money at 2% for 30 days. So essentially, we look to match and make sure there's enough of a margin between the two, and also that we're able to time the cash flows, but it's part of the whole art of what we do. And that you'll have multiple maturities, you're growing your business, so we're always looking for more capital. Our clients, we're always looking for new clients, and it's an ongoing challenge, but a real challenge. Yeah.
What are some of the other challenges that you face?
I think going back, for sure, there's the novelty of what we're doing and having to explain it to our clients. They've never even heard of this before. There's the novelty of who we are. So you're not a bank, not microfinance here. You're not a Sako. What are you? Is having to sort of explain that. I would say there are challenges we also face in terms of managing the risk, what we do. Making sure that clients do not defraud us, as is, there's a very high risk to that. I think there are also challenges really of we want to serve people in the agricultural space. These people are in geographically remote areas. It can be quite expensive. So in fact, we've been very fortunate to receive a grant from an organization called AGRA, the Alliance for Green Revolution in Africa. It's a $500,000 grant specifically to push our supply chain finance product I just talked to you about. It will cover not only ways in how we reach these clients, but also some of the costs associated with that. Because in the past, we had tried this before with our own capital, but that runs out very quickly and gets very expensive. So some of the challenges I think have been where we want to create some of the greatest impact. It can be sometimes very expensive and take quite a bit of time to explain what you're going to do. There's a natural and I think justified skepticism around new financial services providers, especially for your business, because if you hang on to a provider and the provider cannot give you the same service next month, your business is in a very tight position. So our clients, I feel, also assess us as much as we assess them.
Are you finding you're getting any competition?
Oh yeah. Not just from banks. We now have non-banks, people like us that are coming to the market. But the gap that we're trying to solve is so large. You're talking about how many SMEs want credit but cannot access it from banks. It goes beyond agriculture. We just chose agriculture because it's one of the largest sectors. It's 25% of this country's GDP. And yet banks together are lending less than 3% of their loan book. So it's a classically underserved segment. We have new competitors that are coming in and they are focusing on different sectors. Transport, logistics, services, you name it. We just chose one. So in terms of our sector, I only know one other company that has a specialist focus. And we're frenemies, I even say. We both realize how hard it is we're trying to do and accomplish. And we know that there's so much more out there to get. So we never coach each other because, why would you? Just go out and get the rest.
Play more fish in the sea.
Exactly.
What has been sort of the biggest learning that you've had, or the thing that's kind of surprised you most?
I'd say when I left the bank to start this business, to provide credit, I really thought that a lot of clients would jump at the opportunity to get credit. I was very surprised at how much they put us under due diligence, before taking our money. I think, consumers and borrowers are wiser. They will really think, first of all, is this a good rate? Is this a sustainable source of funding? Plus, do you work with? I was surprised about that. That would definitely be one thing I was very surprised about.
Okay, so just a few more questions. Right. If you sort of project forward 3 years, what does Umati Capital look like?
In 3 years' time, Umati will be operational across the region and expanding.
By the region, you mean
East Africa. East Africa. We really have a Pan-African vision and dream for this company. We see the same need and demand for our products everywhere, right? We, in fact, are already dealing with clients who are selling into Uganda, Tanzania, and Rwanda. And they're saying, well, when are you going to come and help me do this there, right? So for sure, we will be across all the regions and profitable in all of those regions that we're serving. I think that we would have definitely expanded the impact of what we're doing. I talked to you next year about trying to do your 15,000 to 20,000 new clients in the supply chain finance. For us, we really see the goal of taking this up into the hundreds of thousands of clients. And it's possible. It's really possible to have a small company come out of nowhere and create massive impact. Because the gap we're trying to solve is so large. Even if we were doing at several 100,000 clients, it would be no more than a few percentage points of the total demand that's out there.
And for people listening at home, how can they follow the story?
Well, there's trusty Google. You can get a Google News alert, Umati Capital. You can go to our website and look at updates that we place there. But I'd ultimately say watch the space. Yeah, see what happens.
Awesome. Cool. Well, Ivan, thanks so much.
Thank you very much as well.
Before we head, just a quick moment to say thank you for listening. You can see the show notes of this episode by heading to samfloy.com/podcast and then searching for the episode title. That's samfloy.com/podcast. Now, a few people have got in touch and have been asking about how this podcast came about. And well, it all started when I took a one-way flight to Rwanda to seek out business opportunities across the region. I'm now at the stage of formulating a bit of a plan of the business I want to go into based on all of these podcast interviews, and we'll be keeping a record of what I get up to on my blog. And so if you're interested in being kept in the loop, you can sign up to the newsletter there. Again, it's samfloy.com. Also, if you have any questions, comments or feedback about the podcast, or indeed anything, please feel free to email me, podcast@samfloy.com, and I'd be very happy to chat. In any case, have a great week and speak to you soon.